90% of investors are losing money, and they don't even know it. Picture this. It's 2021. A guy named Marcus, 34 years old, works in IT in Columbus, Ohio, opens a brokerage account for the first time. He's fired up. He's been watching finance YouTube all month. He picks 12 stocks himself, moves fast, trades often, and feels like a genius. 18 months later, he's down $14,000. Meanwhile, his coworker Dana. She put the same amount of money into one single boring fund, forgot about it, and came out ahead. Same market. Same time period. Completely different results. So what went wrong for Marcus, and what did Dana know that he didn't? That's what this video is about. Stick with me. Because by the end, you're going to know exactly which approach actually builds real wealth, and which one quietly destroys it. Welcome back. If you're new here, this channel is about one thing: helping everyday Americans make smarter decisions with their money. No jargon, no fluff, just straight talk. Today we're breaking down one of the most debated topics in personal finance: active investing versus passive investing. Now, you've probably heard these terms thrown around. Maybe you've even argued about it at a cookout or seen it blow up in a Reddit thread. But here's the problem: most of the conversation online is either too complicated, too biased, or straight up wrong. So we're going to cut through all of that. We're going to look at what these strategies actually are, why one of them has a massive hidden flaw most people overlook, what the cold, hard numbers say, and, most importantly, what the average American, with a real job and real bills, should actually be doing with their money right now. Let's get into it. Alright, let's start at the foundation, because a lot of people think they understand the difference between active and passive investing, but they actually don't. Not fully. And that misunderstanding is costing them money. Here's the simplest way to think about it. Active investing is a bet. You're saying, I know something the market doesn't. I can figure out which stocks will go up, and I'll buy those. I'll figure out which ones will drop, and I'll avoid those, or even sell them short. That sounds reasonable, right? Like, if you do your homework, study the companies, follow the news, you should be able to beat the average. That's just logic. Except here's what logic misses: the stock market isn't just you making decisions. It's millions of people, hedge fund managers with $200 million in computing power, analysts who do nothing but read SEC filings 12 hours a day, institutional traders with direct connections to the exchanges, all making decisions at the exact same time. Every single second. When you buy a stock because you think it's undervalued, thousands of professionals already looked at that same stock, ran the numbers 10 different ways, and priced it accordingly. The idea that you found something they missed. That's a tough bet to win consistently. Now, passive investing flips the whole script. Instead of trying to beat the market, you become the market. You buy a fund, usually called an index fund or an ETF, that holds a little piece of every company in a major index, like the S&P 500. That's the 500 biggest publicly traded companies in America. Apple, Microsoft, Amazon, JP Morgan, Johnson & Johnson, all of it, in one fund. You don't pick winners. You own everything. And when the overall economy grows, which, historically, it always has over long enough time periods, your investment grows with it. Think of it this way. Active investing is like trying to pick the one horse in a race that's going to win. Passive investing is like owning a piece of every horse in every race. You don't win any single race. But over time, you're always in the money because some horse always wins. Now, before we go any further, I want to be fair here. Active investing isn't stupid. It isn't just for gamblers or egomaniacs. There are real, legitimate reasons people do it. And we're going to talk about when it might actually make sense. But first, let's talk about the elephant in the room. Here's the thing nobody puts in the headline: active investing isn't just harder, it's more expensive. And that cost is doing serious damage to a lot of Americans' retirement accounts right now. Let me give you a real example. Say you invest $10,000. You're choosing between an actively managed mutual fund, where a professional manager picks the stocks, and a simple index fund. The actively managed fund charges 1% per year in fees. The index fund charges 0.4% per year. Sounds like a tiny difference, right? 1% versus essentially nothing. Watch what happens over 30 years, assuming a 7% annual return for both. With the index fund, your $10,000 grows to roughly $76,000. With the actively managed fund, after that 1% fee every year, you end up with about $57,000. That's a $19,000 difference on one $10,000 investment. Just from fees. Now imagine you're investing $500 a month for your whole working life. That fee difference compounds into hundreds of thousands of dollars. Potentially the difference between retiring comfortably and working into your 70s. And here's what makes it even worse, most of those actively managed funds, after charging you more, don't even outperform the index anyway. So you're paying extra to get less. This isn't opinion. There's an annual report called the SPIVA Scorecard, published by S&P Global, that tracks this stuff rigorously. And year after year, it shows the same thing. Over a 15-year period, roughly 90% of actively managed funds in the US underperform the S&P 500 index. Not 50%. Not 60%. 90%. Think about that. If you walked into a casino and someone told you there was a 90% chance you'd lose, would you play? Of course not. And yet that's essentially what active fund investing looks like over the long haul. But wait, what about picking your own stocks? Cutting out the fund manager, doing the research yourself, keeping all the upside. Here's where it gets even more brutal. Studies on individual investor behavior, and there have been many, consistently find that the average person who picks their own stocks underperforms even the actively managed funds. Not because people are dumb, but because of something called behavioral bias. And this is where Marcus from our opening story went wrong. When your stock goes up 20%, you feel smart. You hold. Maybe you add more. When it drops 15%, you panic. You sell, right at the bottom, to stop the bleeding. Then, when it recovers, you feel like you missed it. So you buy back in at the top. Rinse and repeat. This cycle, buying high out of excitement, selling low out of fear, is so common it has a name, the behavior gap. And it erases billions of dollars in potential wealth every single year in America. The cold truth is this: for most people, the biggest threat to their portfolio isn't a bad stock pick. It's their own emotions in a down market. Okay, look, I'm not here to tell you active investing is always wrong. That would be too simple. And the truth is rarely that clean. There are situations where active investing makes real sense. And I want to be honest with you about that. First, if you have a genuine edge, active investing can work. Not a, I read an article and I feel good about this company, edge. A real edge. Like, you work in an industry and you can spot trends before they're priced into stocks. Or you have professional financial training. Or you're willing to put in 20 to 30 hours a week analyzing companies the way a professional analyst does. If that's you, go ahead. There's a small percentage of people who do this well over time. Second, certain types of active strategies have shown more promise than others. Small cap value investing, buying shares in smaller companies that are trading below their fundamental value, has historically had some periods of outperformance, though it's still not consistent or guaranteed. Third, if investing is a hobby for you and you find it genuinely fun and engaging, allocating a small, play money portion of your portfolio to stock picks can be fine. As long as you treat it like what it is, entertainment, and keep the bulk of your money in something more reliable. Think of it like going to Vegas with $300 you can afford to lose. As long as the rest of your savings isn't riding on it, enjoy yourself. And fourth, there are some specific situations, like managing concentrated stock positions or navigating complex tax situations, where working with a financial advisor who actively manages your portfolio can add real value. Though even here, you want to make sure their fees don't wipe out the benefit. The key word in all of this is intentional. Active investing done with clear eyes, realistic expectations, and an honest assessment of your own edge and time. That's different from active investing done because you watched a few YouTube videos and felt confident. Here's where people get confused about passive investing. They hear passive and they think it means doing absolutely nothing, just dumping money somewhere and praying. That's not quite right. Passive investing still requires a strategy. It just doesn't require you to constantly make decisions or outthink the market. Here's what it actually looks like for a typical American. You open a brokerage account, Fidelity, Vanguard, Schwab, whatever you're comfortable with. You set up automatic contributions every month. Maybe it's $200. Maybe it's $500. Whatever you can consistently do. You put that money into one or two low-cost index funds. Something like a total U.S. stock market fund, maybe a total international fund for diversification, and if you're closer to retirement, a bond fund to reduce risk. Then you don't touch it. You don't panic when the market drops 20%. You don't get excited and move money around when some sector is on fire. You stay consistent. Month after month. Year after year. That consistency is the magic. And it has a name, dollar cost averaging. Because you're investing the same amount every month regardless of what the market is doing, you automatically buy more shares when prices are low and fewer when prices are high. Over time, your average cost per share ends up lower than if you tried to time your purchases. Now let's talk about where you're investing, not just what you're buying. If your employer offers a 401k with any kind of match, and you're not maxing out that match, that is your single highest priority. Right now. Before anything else. A 100% match on the first 3% of your salary is an instant 100% return on that money. No active strategy in the world can consistently beat that. After that, max out a Roth IRA if you qualify, up to $7,000 a year as of 2024. You invest after-tax dollars, it grows completely tax-free, and you pull it out in retirement without owing a cent to the IRS. For most working Americans, this is one of the most powerful wealth-building tools available, and a huge percentage of people have no idea it exists. Passive investing isn't exciting. There are no hot tips. No big wins to brag about at dinner. But there's also no $14,000 hole to climb out of. Let's bring it all home. Here's what the data shows, here's what real investor behavior shows, and here's the framework I'd give to any friend who asked me what to do. 1. If you're just starting out, keep it simple. 1 or 2 broad index funds. Low fees. Consistent contributions. Automate it so you don't have to think about it. 2. Don't let boring fool you. Passive investing feels boring because nothing dramatic is happening. But that's the point. The people quietly holding index funds through 2008, through 2020, through every scary headline, those are the people who built real wealth. 3. If you want to try active investing, set a hard limit. No more than 10% of your total invested money. Treat it as your exploration bucket. Learn from it. But protect the core. 4. Fees are not a small detail. They are one of the biggest determinants of your long-term returns. Before you buy any fund, mutual fund, ETF, anything, check the expense ratio. If it's above 0, 5%, ask yourself why. Anything above 1% should raise a serious red flag. 5. Your worst financial enemy is the version of you that panics in a down market. Build your portfolio around the assumption that markets will drop, sometimes dramatically, and that you will not sell. If you can't honestly say you'd hold during a 40% crash, adjust your allocation now, before it happens. The truth about active versus passive investing isn't really about the strategies themselves. It's about human psychology. The passive approach wins, for most people, not because it's mathematically perfect in every scenario, but because it removes the emotion. It removes the temptation to react. And it removes the fees that slowly bleed you dry. Marcus lost $14,000 because he trusted his gut over history. Dana built wealth because she trusted a boring system over her own instincts. One of those is a lot harder than it sounds. If this video helped you think about your money differently, even a little bit, hit that like button. It genuinely helps more people find this content. And if you know someone who's been debating whether to pick their own stocks or just go with an index fund, send them this video. You might save them a lot of money and a lot of stress. Subscribe if you want more no-fluff, straight-talk finance content every week. New video drops soon on the biggest mistakes people make inside their 401k, and how to fix them fast. Until then, stay consistent, stay boring, and let compounding do the heavy lifting.